Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and we are continuing with our FM chapter-wise division. If you have made it till this video, that means we are on the verge of completion of the syllabus. This is the very last chapter, and primarily it pertains to all of the formulae which we have learned so far in whatever we have studied in FM. So number one, so different types of ratios are there. First of all, we have profitability ratios. So these ratios pertain to how profitable a business is. Number one is the gross profit margin. So this is nothing but your GP divided by your sales multiplied by 100. So these, because we are multiplying with 100, your answer will always be in a percentage form. Now the next one is your operating profit margin. So over here, your numerator becomes PBIT, which is profit before interest and tax. You divide that by sales and you multiply it by 100. So you get your operating profit margin. Third one that we have is our ROCE, return on capital employed. So this is nothing but your PBIT, profit before interest and tax, divided by capital employed. Again, you multiply this by 100 and give your answer in a percentage format. Then we have return on equity. This is also called ROE in short. So the formula for the same is profit after tax minus your preference dividends divided by shareholders funds. These will always be ordinary shareholders that we are talking about. Ordinary shareholders funds, and this will be multiplied by 100 again. Now, how basically you're going to find out the capital employed which we have studied? So capital employed is nothing but capital employed is equal to shareholders funds plus long-term liabilities. This is also another method to calculate is total assets minus current liabilities. So these two formulae can help you calculate capital employed. Whichever information you have readily available, you can use that very information. Then the next type of ratios are liquidity ratios. Under liquidity ratios, we have only two. First is the current ratio. Current ratio is nothing but your current assets divided by your current liabilities. And then the second one in this liquidity category is your quick ratio. Quick ratio will be equal to your quick assets. Quick assets are nothing but your current assets minus inventory divided by current liabilities. My apologies. Now we are done with liquidity ratios. The third one that we have is efficiency ratios. You can also call it as activity ratios. Activity ratios. So the number one that we have in this category is our receivables collection period. Now, this basically represents how much time your receivables are taking to pay you the money, or how much time you are taking to collect the money from the people who owe you money. So the formula to work out the same is your average accounts receivable divided by your annual credit sales, and the same needs to be multiplied by 365. With this you will have your answer in terms of number of days. The next one is payables payment period. This is equal to your average accounts payable divided by your annual credit purchases multiplied by 365, again giving you your answer in terms of number of days. Then you have your inventory holding period. Basically signifies how long do you hold your inventory before it gets sold out. So this is nothing but average inventory divided by your annual cost of sales multiplied by 365. Then one more thing that you calculate through all of these things is your operating cycle. This is also called the cash operating cycle, or you can also call it as your working capital cycle. Cash operating cycle or your working capital cycle. So the formula to calculate the same is your inventory holding period, inventory days, plus the days that you are taking to collect your receivables, minus the time that you are taking to pay out your payables. So this is the formula that we have for cash operating cycle. The next formula that we learn is the asset turnover ratio. So this is equal to your sales divided by capital employed. And then last one in this category is sales to working capital ratio. So the formula itself is given you in the name of the ratio, which is sales divided by working capital. So these are the efficiency or activity ratios. Now the next type of ratios which we learn, the fourth category, is your financial gearing ratios. Now, what sorts of ratios do they, have in this category? Financial gearing basically means the presence of debt in a company's capital structure. So it's going to be nothing but, comparing debt to equity. So the first ratio is debt to equity ratio, where you find it out as non-current liabilities divided by capital plus your reserves, and you multiply this by 100 to give you a percentage. Then the next one is debt to total capital. So here you are comparing how much is your debt compared to the total capital that you have. So here numerator remains the same, just the denominator is changing, which is capital employed. Now you multiply this by 100 and you have your ratio. So this was about financial gearing ratios. The fifth category of ratios are operational gearing ratios. So operational gearing means how much are the proportion of your fixed costs, how much operationally you are bound. So operational gearing can be calculated as fixed operating costs divided by variable operating costs. multiplied by 100. So this gives you a percentage. Another formula to do the same is you can compare the fixed operating costs to the total operating costs. And then one more formula to which is also used to calculate operational gearing is your contribution divided by PBIT. So which formula to use in the exam? Either it will be given that you have to compare this thing and this thing. Otherwise, you can use the formula of, out of the three, whichever one you want, and all of the three answers will be marked as correct. Then the sixth category that we talk about is going to be risk ratios. Risk ratios. Now, under here, we are basically seeing how risky or less risky a business is. So, the number one that we talk about is going to be interest cover ratio, interest coverage or interest cover ratio. So, this is nothing but we are comparing PBIT with the interest expense that we have. So, basically, we are seeing how many times does the business earn a profit before interest and tax to be able to pay interest. So your answer over here will always be in times. Let's suppose my interest is 100, is 10 and my profit is 100. So I can pay my interest 10 times with the amount of profit that I make. So this is what interest coverage ratio is about. Number two is your cash flow coverage. So over here, your numerator is cash generated from operations. How much cash you are generating from the business, the operations that you're carrying out, divided by the interest expense. So this is the formula for cash flow coverage. Now the last category of ratios that we talk about is going to be our investor ratios. So my investor ratios are, number one is your earnings per share, EPS. So the formula to calculate the same is profit after tax minus preference dividends divided by your weighted average number of ordinary shares in issue. Then another way to calculate EPS is the DEPS, diluted earnings per share. So this is calculated using the formula profit after tax minus preference dividend plus PDS adjustments divided by ordinary dividend plus your PDS. All right. So continuing with investor ratios, number three is PE ratio. So as the name suggests, in your numerator, you have the price, which is the price of the ordinary share. So ordinary share price in the market, and then you divide that by the EPS, which is the earnings per share. And there are more investor ratios. Number fourth being dividend coverage. So again, how many times will the company be able to pay dividends with the profits that it has? So profit after tax minus preference dividend divided by ordinary dividend. Then another ratio that we have is dividend payout ratio. Dividend payout ratio. So this is equals to your ordinary dividend divided by profit after tax minus preference dividend. So whichever is the money that is left for the shareholders, out of that money, how much is the dividend which is being paid gives you your dividend payout ratio. Then the next one is dividend yield. Dividend yield is equals to dividend per ordinary share divided by the share price. So ordinary share price multiplied by 100. So this gives you a percentage answer. Dividend yield is in percentages. Next one is called earnings yield. So earnings yield is equals to nothing but your EPS divided by ordinary share price. So here you are comparing based upon the share price, how much has the share given you in terms of earnings. Then last but not the least is called total shareholder return, the TSR ratio. So this is equals to your year-end share price minus share price at start of the year plus the dividends that were paid during the year, dividing this whole thing by the share price at year end. And you multiply this whole thing by 100, so you will get your total shareholder return in terms of a percentage. So with this, we have covered the last chapter that we had in the FM syllabus. I hope that the entire revision series was useful for you. You benefited from it, and all the very best for your exam. I pray that you all do very well. Thank you so much for watching. All the very best.